We at Radio Higher Ed are pleased to present this podcast in collaboration with the Post-Secondary National Policy Institute, known as PNPI. PNPI is the leading provider of professional development for current and prospective policymakers who work on higher education issues. This podcast is designed to explore the strengths and weaknesses of the current loan servicing system. Over the last several years, borrowers, financial aid officers, and others have expressed increasing concerns with the design and management of the direct loan servicing system. So, to better understand the current system, we've invited Justin Draeger to join us today. Justin is the president and CEO of the National Association of Student Financial Aid Administrators, also known as NASFAA. He serves as the primary voice of NASFAA and the liaison between the association members, the U.S. Congress, federal agencies, and the media. Most of Justin's career has been devoted to assisting disadvantaged populations achieve their educational goals and better their communities. Thank you, Justin, for being with us today.
My pleasure.
Can you tell us why institutions are concerned about students paying back their loans after graduation?
Written into the law, schools are held accountable for how many of their students successfully repay or default on their student loans. So there's a very strong incentive for schools, if they want to continue to offer any federal student aid, that's Pell Grants on top of loans, they have to have a student population that is successfully repaying their loans or at least staying out of default. And then on top of that, there's an altruistic reason. People that are in financial aid are usually in it and stay in it for a reason, and that gets at helping students. So they want students to successfully stay on the right side of their loans.
Justin, what are the strengths of the current direct loan servicing system?
One of the things that schools are interested in is making sure that students have the best possible servicing available to them, since that could really make or break whether a student stays in good standing on their loans. So one of the things that schools like about the current system and what they've always liked about student lending is competition. So this idea that you have different servicers that are competing and that competition then should elevate sort of the best practices, best services for students. And right now, as it's currently constructed, there is competition built in. Now, I think there's a lot of debate on whether the incentives in that competition are adjusted correctly, but the fact remains we have multiple servicers and lots of competition. And that usually means that if you're competing for something, you're going to do the best you can.
Given that context, what would you say are the weaknesses or concerns that borrowers and the financial aid administrators have raised about the current system?
So it's the flip side of this coin with the competition. Yes, having several servicers means competition, but the other side of that is it can mean inconsistent practices. So from a financial aid office's perspective, I like to think about it, from an anecdotal perspective to reinforce the statistics. If I'm a financial aid office, I'm working with my borrowers up front. I'm giving them entrance counseling before they take the loan. Maybe I'm talking to them in school while they're taking the loan. And then I'm required to give them some counseling as they leave my school. Now, sometimes the students don't want to take that counseling, but from a school's perspective, that's really their last touch point with the student, unless the student voluntarily comes back and makes contact with the school. In instances where that's happening, we have about 50% of our members. We distributed a survey in the last year and a half, and about 50% of our members who said they were witnessing some problems with loan servicing said that one of the disadvantages was that they were having trouble identifying consistency among servicers. And that could be anything from like how those servicers handle certain paperwork or verification documentation on income or process deferments or forbearances. And that makes it really difficult for a school to counsel a student if they're not sure from servicer to servicer how some practice is going to be handled.
So then, to what extent are concerns from borrowers or financial aid administrators related to the current system's design and management by the U.S. Department of Education?
So I think the answer here is that an awful lot is dependent on the U.S. Department of Education, because they are ultimately, on behalf of the taxpayer, on behalf of the government, they oversee the servicers. They are the client on behalf of all of us. And so I think we are looking for the Department of Education, not only the servicers, but ultimately the solution to this really has to fall with the Department of Education and how they set up the parameters of loan servicing. So we could, for example, on the consistency issue that I identified earlier, One of the more common issues identified by our members, by colleges and universities, is that they are seeing different servicers apply loan payments differently. So, for example, if a borrower makes a payment above and beyond what's due that month, they were seeing inconsistency in how those payments were being applied. And this was rated as one of the most pervasive findings of our members. So they could go to all the different servicers and say, when you experience a lump sum payment or an overpayment, how do you deal with that payment? We could try to identify all the different practices and put something together, but that would then require us to proactively go out and keep surveying in case practices change. We could ask the servicers to get together and produce a manual that would be common to everyone so we can see where there are alignments and differences. But ultimately, the servicers aren't going to take those actions without approval and or pressure from the U.S. Department of Education, which is, again, the contract holder. So we really think it largely falls on the Department of Education to formulate a stronger servicing requirement.
So to what extent are these concerns related to the servicer implementation?
The real tension here, and I cutting the Department of Education a little bit of slack here because we really have tensions that have to be balanced. So here are, for example, two tensions that I think the Department of Education has to grapple with. The first is a single solution provider versus having competition. And that is really the billion-dollar question, or if this contract, given the size of this contract over 10 years, it's really like the $7 to $10 billion question, because that's how much these contracts could be worth looking forward. And the department has to decide whether they're better off using one servicer, which then it becomes very easy to have commonality. It's very easy to accomplish all the goals of consistency because you have one servicer that you're working with. The downside to that is that it's a single point of failure. And you really lose the opportunity to shift allocations or shift an entire loan system to another servicer if that one servicer you chose lets you down. You have to temper that with competition, which is the idea that if you have so many, then you have all of these inconsistencies. So that's a tension the department has to navigate. The second tension, I think, is really to what extent should servicers be incentivized or required to go and help a borrower? So at some point that each of these servicers, I'm sure, is able to do, they are losing money on how much time or energy they're investing on a borrower who isn't repaying their loans. And it becomes a financial question to them. Now, I don't have any hard proof that servicers are doing that math and then saying we're going to just cut ties and give up on certain borrowers. But that math clearly exists. And so we've had like this crop up of another industry that's come along. These are third-party servicers that schools hire to do what you would think the federal servicers should be doing, which is identifying borrowers who are in distress and then keeping them from loan default. The fact that you have schools that are paying significant amounts of money to these third-party servicers to do what many would think the federal servicers should be doing, I think that's the other tension. Like where is enough, and how do you build in the incentives or requirements to make sure that every borrower has access to very quality servicing?
How do you think the current system could be improved just right now?
The department has issued over the summer, they issued a very large memorandum, 56 pages. It came out of the Undersecretary for Higher Education's office, and Undersecretary Ted Mitchell sort of provided an outline of how they hope to improve the current servicing system. And I think they're on track with a lot of it. I mean, this memo touched on everything from transparency, which we've talked about, the shortcomings in not being able to see how different servicers handle different processes. It touches on this concept of retaining some sort of competition, yet perhaps having a primary solution provider that is trying to marry these concepts of one servicer, but then around that, multiple other customer service centric type servicers. It touches on things like how you financially incentivize servicers to provide quality servicing. And these are all right now sort of in the principal stages. We haven't seen anything from the department in July, at least publicly, that would say these are the exact financial incentives. But in any case, what I'm saying is how could it be improved? They've I think they have a good handle on how it could be improved. Transparency, consistency, financial incentives, basic requirements in a student aid bill of rights. These are all things they've incorporated into the overarching principles of what they want to achieve with loan servicing. And now we have to see if they can actually effectuate that into action.
So if you could recommend just one change to the federal student loan servicing system that would benefit the borrowers, what would it be?
After I just got done saying how the Department of Education has the primary responsibility here, I do think there's one thing that can be done, but it's not done by the servicers or the Department of Education. It really, I think the single biggest thing that would improve loan servicing lies with Congress. And it really comes down to two things. One, we have to simplify the number of repayment plans that we have. No amount of good servicing can make up for the confusion. I mean, just mind-boggling confusion of the number of repayment plans that are currently available. And some of them are available to borrowers based on when they started borrowing on these loans, and other repayment plans are available to the same borrower on these other loans. It's way too complicated, and no amount of good servicing can make up for that. And then the second thing that we really need Congress to take a look at is we have these income-driven repayment plans, which means it's a repayment that's based and capped on your income. And if you don't make enough money, your repayment could be as low as zero. Why in the world would anybody default on a loan with an income-driven repayment plan? Yet we still have people that are defaulting. So what we really need Congress to do is look at providing some avenue that when the federal government knows how much you make, whether it's through the IRS or Social Security Administration, and if you're falling delinquent on your loan, that there's some method to automatically enroll people into income-driven repayments so that they can stay current on their loans without defaulting. So I don't mean to, I'm not trying to dodge the question about servicing, but I really think those are the two things that could have the biggest impact, really, I think perhaps lie with Congress.
If you were to recommend one change to the federal student loan servicing system that would make the work of financial aid administrators easier, what would that be?
To us in the field, it's very opaque. So the thing that would make this easier for us is a publication of some manual that's common to all servicers. We're not saying that all servicers have to do things the exact same way. We want to foster the nature of innovation and competition, but trying to put together what all the different practices that servicers do is very difficult. So the thing that would really make this easier for us is when a student comes in and they say, we're having trouble making payments or getting in touch with my servicer, or what are my options? It would be much easier for us to be able to look at some manual, common manual, that would say, well, this is how your servicer handles XYZ, and to be able to provide some real assistance, because as of right now, it's very opaque to the financial aid offices. We don't know exactly how each servicer is handling everything except through trial and error.
Well, this is very, very useful information. You've helped take a complicated topic and brought it to the level where the layman could understand it. So many, many thanks. Appreciate it.
My pleasure. Thank you.
For those of you who are interested in further exploration, a 2015 NASFAA Task Force report on servicing issues has been posted on the Radio Higher Ed website. On behalf of PNPI and Radio Higher Ed, we hope you found this podcast has added to your understanding of loan servicing. And you're invited to join us for future professional development activities and podcasts on important and emerging